Hi everyone, welcome to the US CPA Business Review and Analysis classes. Yes, this is bar classes, and today in this particular video we'll be discussing in detail about prospective analysis, including the use of data, and specific topic we'll be covering is a break-even analysis. So let's understand more in detail about break-even analysis.
Hi everyone, welcome to BAR classes. In chapter 2, we are at 2.2 prospective analysis including the use of data. So we have started with budgeting, forecasting and projection, which is 2.2.1. And that in last class and day before last class, we have covered most of the things which include budgeting and analysis. We covered SWOT analysis, we covered balance scorecard, we have also covered 5 force analysis and financial modeling. Yesterday we covered forecasting and projection, both quantitative analysis and qualitative analysis. Then after we did regression analysis. Today we are going to finish the break-even analysis. Do you guys have any idea what is break-even analysis or break-even point is all about? Yeah, any thought what is break-even analysis, or have you guys studied this in your college days or maybe in your other professional qualification days? No? Or okay, no worries, we can cover over here. So break-even analysis, basically as the name suggests, it is a point which tell you at what point or at what revenue your business will reach to a break-even. That means where your sales is equal to your cost, or your revenue is equal to your cost, and you are at zero profit. So that point is called break-even point. Why the break-even analysis is being very important for any organization? So that company can understand at till what point at least they should be generating the revenue, so that they will not be paying from their own pocket, right? It's a financial calculation that weight the cost of new businesses, services or product against the unit selling price, to determine the point at which entity will be at break even. Or in simple word, if I say, it is a point at which the entity will sell the units to cover all its cost, right? When it says all its cost, it include your cost of goods sold as well as your other cost, which is your payroll cost, travel cost, business development cost, insurance cost, marketing cost, sales, administration, journal, everything, right? So break even point is actually a point where company generates sufficient revenue, or company generated the revenue which is covering their entire cost, but at this point of time they're not making money, they're not making profit, right? So there's a formula to it if you have to calculate, and this is like kind of very important. At least I would say you'll get few question in your exam for the break even point for sure. So this formula you all should be very well aware of. It's a point where the company do not earn any profit, but at the same time they're not making any losses as well, right? So break even point in units. First, like in your question, you need to do the mathematical calculation to understand the number of unit you need to sell at the respective selling price to recover all your cost. The cost include your fixed cost and variable cost, or you can say cost of inventory plus other cost as well, right? So break even point is basically the point at which total fixed cost divided by contribution margin. Have you heard this term before, contribution margin? Any idea what is contribution margin is about by any chance? Okay, so contribution margin is basically sales minus variable cost. So variable cost include your you can say generally it is being considered as your cost of goods sold, because for each unit you are selling there is an inventory cost which is, you can say, variable based on the number of unit you are selling, right? So sales price minus variable cost is actually your contribution margin. Another thing probably you need to calculate is the contribution margin ratio as well. So contribution margin ratio is contribution margin per unit divided by sales price per unit. For example, if you have let's say $10 is the sales price per unit, and you have a cost of, let's assume, $6 per unit. So your contribution margin is $4 per unit, which is $10 minus $6 is your contribution margin. So contribution margin per unit is 4 and the sales price is 10. That means your contribution margin ratio is 40% or 4:10. Makes sense? That's how you need to calculate the contribution margin, right? So break even sales. So in question you may expect like certain question which will be coming and ask you to calculate the break even sale. So what is break even sale is all about? Break even sale is the number of unit which you are selling at a point where overall cost is equal to your revenue, right? So how do we calculate that break even sale? So number of unit at the break even point multiply by the sales price per unit, that will give you the break even sale. That means this much amount of the sale you need to make to recover all your cost, right? Then the next topic you may expect in your exam is the margin of safety. So what is margin of safety? Any idea? Or by any chance you have heard of this term before? Margin of safety? Yes? No? Okay. Yeah, so margin of safety is basically that margin which is over and above the break even point. That means the sales which you are making over and above the break even point is generally considered as margin of safety, right? So that gives you additional cushion to generate more revenue, so that if there is any contingency cost or if there is any additional cost, those costs you can comfortably manage, right? So that is called margin of safety. So how do you calculate margin of safety? Your actual sale or your budgeted sale, whatever is it, minus the break even sale is called margin of safety. That means sales value over and above the break even sales at a break even point is called margin of safety, right? Any doubts so far? Okay. Therefore, it helps measuring how much sales have to drop before a loss is incurred. That means, like why the company need to calculate margin of safety, so that they can understand how much is the cushion they have if for any reason sales will go down, right? Till what point it will still be in a profitable position, till what point the company will still be in a break even, at what point is a triggering point to start making losses, right? So the margin of safety helps you identifying or giving the cushion or giving the amount till the time company is making revenue over and above the break even point. That means if margin of safety go down, that means the total sales is near to or close to the break even point. That means if any contingency do happen, the company may not have much cushion, right? So margin of safety help in identifying the cushion which company do have to incur the losses or to reduce the revenue, right? Sales unit of desired therefore it helped me with, yeah. So one more thing is, sometime in your exams you might have given some desired sales and ask you to calculate the profit, or sometime in the question it has been asked, they will ask you to achieve the desired profit, how much sale you need to make. then in that case of scenario, you might be using this formula, which is total fixed cost plus desired profit divided by contribution margin per unit. Right? What does this formula state for? To calculate the desired profit for the organization. If you have to calculate the desired profit for the organization, how you will be calculating? Fixed cost plus desired profit divided by contribution margin per unit. Right? Any doubt on this formula?
So these all the formulas we will have to mug up, right?
Yes. This formula you need to pen down. Yeah.
Okay.
Therefore, and this profit, this desired profit, if they have given profit before tax, then this formula is sufficient. But if they ask you that company desire profit after tax, then in that case of scenario, you need to apply the formula net profit divided by 1 minus tax, so that you can reach to the profit before tax.
Okay, got it.
Right. So if you have to calculate the profit before tax, you will be using this formula to make it before tax. If you have given net profit, then you need to gross it up first. Right. So everyone understood this formula. So I request you, like if now we are going to do a lot of practical question. So I request you to please note down this formula and all this calculation now onward we are going to do. So you will be doing the calculation. So for that I request you to please note down these formulas. Everyone, please just note down the formulas so that now we are jumping onto the question side. So there would be a lot of questions which we will be doing, and those questions require usage of these formulas. Right, break-even point unit is total fixed cost divided by contribution margin per unit. Contribution margin ratio is equal to contribution margin per unit divided by sales per price per unit. Break-even sales is equal to break-even unit multiplied by the sales price per unit. Margin of safety is equal to actual or budgeted sales minus the break-even sales. Right, and then sales unit for desired profit is equal to total fixed cost plus desired profit divided by contribution margin. Or if the profit is given after tax, then you need to make it before tax. How do you make net profit before tax? Net profit after tax divided by 1 minus tax rate. Right, have you all noted down these formulas?
No, sir, just 2 minutes.
Yeah, please do this because we'll be using lot. Yeah, Manish, Surya, Arun, have you noted down these formulas?
Noted, sir.
Okay. Yeah, because like after this we'll be starting practical question. So there we'll be using all these formulas. Yeah, Kashish done?
Just 2 minutes.
Right, done, Kashish?
Yes, sir.
Okay. So there is an example. Direct material is $10. Direct labor is also $10. Variable factory overhead is $2. Fixed factory overhead cost is $90,000 per year. Variable selling expense is $1 per unit, right? And the fixed selling expense is 30,000 per year, and selling price is 29, right? So they ask you three things to do. One is calculate break-even unit and break-even sales. So how do you calculate break-even unit and break-even sales? What is the total fixed cost? What is the formula to calculate break-even unit? Total fixed cost divided by, guys, if you are not responding, then how do we move forward? I am not sure whether you are studying with me or you just open the mobile and like you are doing your own work.
No, sir, देख ही रहे हैं.
No, I'm asking to others. Like I am not receiving any response. Arun, Manish, Surya, are you guys here or you just open your mobile and class is on? Yeah, Harini.
I'm here, Kamal. Yes.
Yeah. So what is the formula for calculation of break-even units?
Total fixed cost divided by contribution margin per unit.
So what is total fixed cost? The factory fixed cost 90,000 plus selling fixed cost 30,000, right? How much is total?
120, 100, 120,000.
120,000, right? That's a fixed cost. And then second thing, what you need to do, calculation of contribution margin, right? What is the sales price? How do you
29.
calculate contribution margin? Sales price minus your direct material, labor, factory overhead, right? Yes, no.
सर ये कहाँ से लिया आपने ये वाला फॉर्मूला?
Which formula? Contribution margin.
हाँ.
So contribution margin is equal to sales price minus variable cost per unit,
Got
right? So what is the sales price? 29. And what are the variable costs here? How much is the variable cost? 23, right? Kashish.
Yes, sir, 23.
So what is the contribution margin? $6,
Yes, sir, 29 minus.
right? $6 is my contribution margin. So denominator is 120,000 and numerator is $6. So how much is the quantity coming out? 20,000 unit,
Yes, sir.
right? So what is the solution? The first, contribution margin, right? For the contribution margin, you have sales minus all variable cost, material, labor, overhead, and selling expenses, right? So it will give you total cost, right? So your contribution margin is $6, right? So $6 is the contribution margin. So break-even point is total fixed cost, which we have calculated 120 divided by 6, right? So 20,000 units. So far so good. Everyone agree how we have calculated 20,000 unit?
Yes, Kamal.
Yes, sir.
Okay. So next question they have is what is the sales value at break even? So you have 20,000 unit and what is the sales price? $29. So what is the value of sale? 20,000 multiplied by 29. How much is it? Dollar
580, sir.
580,000. Right.
Yes,
So
sir.
this is the response to the first question. Right. So far so good. So what is the second question? How many unit do they need to sell to generate 90,000 profit before tax? So what is this? Desired profit is 90,000, right? What is total fixed cost? 120,000. So what will be the numerator? 120 plus 90. How much is it? $210,000. Yes, no.
Yes, sir.
And what is the contribution margin per unit? $6, right? So what is the call of the question? How many unit they need to sell? So total fixed cost plus desired profit divided by contribution margin, 120 plus 90 divided by 6, right? So 210 divided by 6 is 35,000 unit. So how much unit they need to sell to achieve 90,000 profit before tax? 30,000, 35,000, 40,000, 45,000. Hmm? Yes, no. Any response? Guys, you're spending your Sunday, so at least take a best utilization and stay with me. Yeah, I know it's being my duty to take the classes because you have paid for it, but at the same time, if you're not engaging with me, it will be of no use for you. And you are sparing your Sunday, just so why don't you make best use of the classes and stay engaged in class? I will just walk you through with all the questions really quick and then we can be done with the class, but you will not get actual benefit of the class if you don't get yourself engaged, and then you will struggle in exam. At that point of time no one will be with you. Third question is how many unit do they need to sell to generate 90,000 profit after tax, considering 40% is the tax rate. So profit after tax 90,000. So what is the profit before tax required? 90,000 divided by 1 minus 40%. Right? How
Point.
much is that? $150,000.
Yes, sir.
Right? So the required sale will be fixed cost plus $150,000 divided by $6 per unit. That is 45,000 unit. Right? So 45,000 unit and $29 per unit. So you need $1.305 million of sales. Right?
Yes.
Here, if they ask you to calculate the margin of safety, also calculate the margin of safety. How do you calculate margin of safety? Is equal to sales, which is actual or budgeted, minus sales at break even. So $1.305 million minus 580,000 which we have calculated sales value at break even, right? So this will give you $725,000 as a margin of safety. Make sense?
Yes, sir. Clear.
Hmm.
The formula you remind करना basically.
Yes. In the costing, you need to just keep in mind the formula, and sometimes it is confusing because there are lot of formulas. Same way, like if you remember when we have studied for the standard costing, there were so
Yes,
many
sir.
formula for material variance, labor variance,
Hmm.
overhead variance, right? So same way here also, I would request you to note down all the formula at one page so that in last minute you have something to quickly run through.
Yes, sir.
Okay, next question. Sales is 50,000 unit at the rate of $20 per unit. It should be
हाँ सर एक जीरो डाल
$2.
दो.
Sorry.
Either it is 10 lakhs or either it is 2. So,
Let me see. So I think it should be 1 million because the cost is coming 300. Direct material and direct labor is $300,000. Factory overhead is 40,000 variable, 70,000 fixed. Selling and journal expenses 10,000 variable and 60,000 fixed. So calculate the break even number of unit and calculate the contribution margin ratio. How do you calculate break even unit? What is the formula? Total fixed cost divided by
contribution
contribution
margin.
contribution margin, right? So first you need to identify the fixed cost. So fixed cost is 70,000 factory and 60,000 selling. So 130 is total fixed cost. And what is the contribution margin? What is sales price? 20, right? $20 per unit.
Yes, sir.
What is the variable overhead cost and variable sales and general cost?
So 50,000.
50,000 divided by 50,000, that is $1 per unit, right? And what is the direct material and labor cost? 300,000 divided by 50. How much is it? $6,
6. Yes, sir.
right? $6 is material and labor cost, and $1 is overhead and selling and general administration. So how much is the total cost? $7, right? What is the
Yes, sir.
contribution margin? 20 minus $7. $13 is your contribution margin. Make sense?
Yes, sir.
Right? If $13 is your contribution margin, what is your fixed cost? What is your fixed cost in this example?
तो इसको मल्टीप्लाई कर दो.
No, what is the value of fixed cost? Hmm? What is the value of fixed cost? We
तो 70.
discussed this 70,000 plus 60,000, 130,000, right?
Yes, sir.
So 130,000 divided by contribution margin of $13. So how many units? 10,000 units,
10,000. Yes, sir.
right? So you require 10,000 unit for break even. What is contribution margin ratio? 13 divided by 20, right? Contribution margin divided by total sale is contribution margin ratio, right? Any doubts so far? Okay.
Oh, sir, clear.
Next example. Variable cost is equal to 25% of sales. Fixed cost is 30,000. Calculate the break-even point in sales value. So fixed cost is 30,000. Contribution margin ratio is 75%. Right? So what will be the break-even point of sale? That is $40,000. Right?
Yes,
So far
sir.
so
Yes.
good.
Yes, sir.
How you have calculated this?
The total fixed cost upon my contribution margin ratio.
What is contribution margin ratio?
तो 25% ऑफ सेल्स हो गया ना, तो 75% हो गया रिमेनिंग।
But what is the formula to calculate contribution margin ratio?
और सर कंट्रीब्यूशन मार्जिन पर यूनिट डिवाइडेड बाय सेल प्राइस।
Contribution margin ratio is contribution per unit divided by
सेल
sales
प्राइस।
price per unit, right?
यस।
So that is 30,000 divided by 75% is equal to 40,000, right? Everyone agree? Question? Harini, Surya,
सर यहाँ पे वो लिख दो फॉर्मूला ना,
what?
सो दैट
क्या formula?
कंट्रीब्यूशन मार्जिन डिवाइडेड बाय सेल प्राइस।
It's already there.
हाँ वो ऊपर है ना, तो इस सॉल्यूशन के साथ हो जाएगा तो सर।
Okay. Contribution margin is equal to contribution margin divided by what? Sales. Right?
यस सर।
Okay, next question. So today we'll be doing lot of illustration, but I know people are not engaging, so can't do anything. But these all questions are very important because this kind of calculation only you will see in exam, and you have to do all this calculation at your own during the
यस
exam,
सर। ये
right?
सर आएगा ही आएगा, इट्स वेरी
Hmm.
इंपॉर्टेंट। हर
Hmm.
बार ही आता है ये।
Right. So, next example is sales is $200,000. Your contribution margin is $120,000. Your fixed cost is 90, and your income tax is $12,000. Calculate the margin of safety. Right. So you have given contribution margin 120,000 and sales 200,000. Right. So the fixed cost they have given you $90,000 and income tax you have $12,000, and they're asking you to calculate the margin of safety. So first is contribution margin ratio, that is your contribution margin divided by sales. So that is 60% coming, right? So break even point should be what? 120,000 is fixed cost divided by 90,000 is your fixed cost divided by 60%, that is $150,000 of sales will help you to reach to the break even point. So break even point of sales is $150,000 and actual sale is $200,000. So the margin of safety in terms of sales is 200 minus 150. Right? Make sense?
यस सर।
Okay. Next question. So let's just look at the question. X company is planning to sell 200,000 units of product A. The fixed cost is $400,000 and variable cost were 60% of the sales price. In order to realize a profit of $100,000, the selling price per unit would have to be how much? So they are saying 60% is the contribution margin, right? And the fixed cost is how much? $400,000,
यस सर।
right? And what is the desired profit? $100,000, right? Fixed cost plus desired profit, that is $500,000 divided by contribution margin ratio. that is 40%.
60% another contribution margin issue.
No, variable cost is 60%. So contribution margin is 40%, no?
Okay.
Right? Sales minus variable cost is your contribution margin. If sales is 100 and your variable cost is 60, so contribution margin is 40. So what is the core of the question? Identify the sales price. Can you do the math for me?
Yes.
Arun, Manish, Harini, Krishan, Surya. Guys, can you calculate this?
Yes,
What
sir.
is so what is contribution margin? What is contribution margin? Are you guys doing this?
Yes, sir.
So fixed cost is $400,000. Desired profit is $100,000. Contribution margin ratio is 40%. So the sales value to earn 100,000 profit will be fixed cost plus desired profit divided by 40%. That is $1.25 million. Right? So what will be the sales unit? Your sales unit is $200,000. That is given in question. So the core
Yes.
of the question is what will be the sales price? So $1.25 million divided by sales unit, right? So that is $6.25 per unit should be your sales price. Make sense?
The contribution margin is 40% क्यों लिया था हमने एक बार कैसे?
Because 60% is the variable cost. So remaining 40 will be the contribution margin. So contribution margin is equal to sales minus variable cost, right? So what is variable cost? That change according to the change in number of unit, right?
Yes, sir.
So if number of units are changing, then accordingly you need to change this.
वही सर ये पूरा मगअप करना पड़ेगा अच्छे से तभी जाके एक एक क्लियर हो.
Yes, right. So there are a few questions. Let's do this question. So in this type of question you will expect in your exam. In calculating the break-even point for a multi-product company, among the given choice, which option assumption are commonly produced when a variable costing is employed? Sales volume equal to production volume. Variable costs are constant per unit. A given sales mix is maintained for all volume change. So, what is the core of the question? Among the given choice, which option assumption are commonly produced when variable costing is employed? What is variable costing? You guys have studied variable costing, right?
Yes, sir.
What all things comes in variable costing? What all factor impact variable costing? Change in volume? right?
Yes, sir.
Change and all the variable cost only, right? So the sales volume equal to production. Will that impact?
No, sir.
Variable cost per variable costs are constant per unit. Is it correct? Hmm? At given sales mix is maintained for all volume change. So when you are doing variable costing, two factor which impact the most, or one, second option is correct. The variable costs are constant. That is the basic assumption you'll be keeping in mind. Second, if there is a sales mix, right, then the volume need to be managed and maintained at each level. So a given sales mix is maintained for change in volume. So the second option is correct option, right? Next question is break-even analysis. Assume that over the range, unit revenue are non-linear, total fixed costs are non-linear, unit variable costs are unchanged, total costs are unchanged. What is the basic assumption when you do break-even analysis? Break-even analysis assume that over the relevant range, unit variable cost will unchanged, right? So the third option is correct option. I think you guys are
सर ये वाला एक बार फिर से बताना ब्रेक
break-even analysis like this variable portion, like here 60% variable cost. So 60% will continue to be 60%. It will not change to 61 or 59.
अच्छा
This is
ओके
what it
ओके
means, right?
गॉट
So maybe I know like you people are not engaging. I would say like take a tea or coffee break and then come back so that at least we have better engagement. Otherwise, I'm also feeling drowsy to be very honest with you. So maybe like if you guys want to take a coffee break, just take a coffee break and then let's come back with like to make it more engaging. Otherwise, it's no use for just open the mobile and like going on a it's